Welcome back to Focus Fridays, a series where we open up the playbook on real estate investing, covering everything from core fundamentals to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Shum, Head of Investor Relations here at Focus Capital.
I'm Chad Schuler, Founder and President at Focus Capital.
Today, we're going to be answering a big picture question. How does real estate actually create wealth over time? So I think that we should take a couple steps back and explain what makes real estate a long-term wealth vehicle. And when people say it builds wealth, what do they mean? Is it just appreciation, or what does that mean, building wealth and a long-term wealth vehicle?
I would say, the wealth appreciation piece of real estate is definitely a lot of how it can build wealth over time. Partly because you've got income coming in, you're paying expenses and the debt pay down. Well, really, your tenants are paying the mortgage, right? Mm-hmm. So you've got increased equity over time. But real estate can kind of snowball over time too. It's like you have the cash flow coming in as well, which is tax advantaged. As you do maybe refinance down the road, redeploy the capital somewhere else and keep the asset, it's a lot of ways can really build our wealth over time. For me, it has so far as well.
I think the nice thing about real estate is it's not, like you were saying, it's not just building wealth in one avenue. It's building wealth in several different layers simultaneously. So you have the tax advantages, which we'll go over in later episodes, but then you also have the equity advantages, because if it's a rental property, you're gonna have tenants from there. And then you also have the cash flow from that if it's not just equity and there's a little bit there. And then, like you said, appreciation. So what are the main drivers of wealth in real estate? Like we talked about cash flow and appreciation, tax advantages. Are there any others that you can think of?
Actually, back up one second, Jerry, because I thought about something here. So I think a lot of misconceptions that people have about the wealth increase of an investment over time. And some people may compare real estate to the stock market and may say, oh, real estate appreciates 7% per year over time, or stock market's the same, right? Well, what you're forgetting is we have leverage with real estate, right? Mm-hmm. So if you leverage 80% for round math and you have 20% equity in the project, if the property increases in value 20%, you've really doubled your investment. You doubled your wealth on that opportunity. So that was a thought that I had.
No, that's great. I think that leads into our next point of like, what are the main drivers of wealth in real estate? We talked about cash flow, appreciation, and tax advantages. I think the two that we haven't double tapped into yet are loan amortization, so the tenant's paying down debt, and the reinvestment of any distributions. Did you want to go over either one of those?
Yeah, let's pick one first and go over that.
Yeah, let's go over loan amortization. What is that? What is amort?
Yeah, amortization is essentially when you pay your mortgage payment, right? Part of it is for interest and part of it is for principal. Principal pay down, paying the loan down, right? Amortization essentially refers to a number of years that is amortized over. So essentially, if it's a loan that's got a 30-year amortization, that means that over a 30-year period of time, you're going to have this chart or this graph that essentially shows here is month 1 out of month 360. Yeah, that's right, I think. Yeah. And okay, this is now we'll go to principal. This is now to interest. Okay, the next month, little less to interest, little more to principal, for example. So that's the whole amortization chart.
Yeah, and I think people that even just have their single family home or their primary residence are kind of familiar with that as well, because it's the same kind of payment schedule or very similar makeup as to multifamily housing or even commercial real estate. There's still advantage, even though we're not in the commercial real estate space, there are still a lot of advantages and long-term wealth vehicles in commercial real estate. Reinvestment of distributions, how would that work? First, what's a distribution, and then what would a reinvestment look like?
Yeah, so essentially, it depends if you're running a single asset fundraise versus a fund. Typically, single asset fundraisers that a limited partner would participate in, those usually can't allow reinvestment and distributions into that one raise. It's already complete, right? It's already closed. However, if you've got a fund, then investors can opt to allow their distributions that are paid monthly or quarterly to be reinvested back into that fund to keep earning your revenue. With our current investors, because we do current single asset fundraises, most investors will basically set the money aside they receive distributions to allocate to the next raise we have, the next investment opportunity.
Yeah, and I think that there's also I didn't talk about this part, but when it comes to distributions, we do have some investors that have invested enough where they just live off of distributions, and so that's also building/creating wealth because they are.
It's passive income.
Yeah, it's passive income, and so they're not having to dip into the other reserves that are already deployed in other avenues.
I think that's like I shouldn't say like the ultimate, the golden, whatever you want to say, but that is like the dream for most passive investors. Is the reason why they do this. The reason why they do passive investments is to have a passive income stream that is recurring, that's not taking their time or work involved, that's being derived from these passive investments they've made in the real estate or other opportunities, that they can live off that cash flow.
Yeah.
And I think if you have a certain number you want to hit per month, you want to live off of, okay, well, we'll take an investments that make that over time. But that's where it can be pretty cool, and those grow each year too.
When I said earlier that it's a long-term wealth vehicle, we're focusing a lot on the wealth side of things, but I think that when some people who maybe aren't, we talked about this in active versus passive investing, aren't super patient, and there's an emphasis on that long-term part. We talk a lot about the wealth, we talk a lot about all the benefits, but we don't really talk about the long-term part of things, and so I kind of want to go into that side of it. Why does time matter so much, and why is patience so powerful in real estate?
When you mention the word time, what that means to me is two things. Number one is you can't time the market. It's more of your time in the market, like in the stock market, right? Same with real estate. Real estate is a long-term play. If you think you're going to get into real estate and flip a deal and get out in a year and time it just right, you might make that work okay, but you might be in trouble too. You want to plan with real estate. Our thesis is, we usually have about a 5-year business plan, but we plan that we could hold forever we had to. We buy it with that intent. So if the market is not doing well in 5 years, okay, we have time on our side. We have the right debt vehicle. We bought at the right basis in the right location. We have the right reserves. We can't hold them forever. So back to the investor, like more or less putting your money into these investments as soon as you can is the best strategy, in my opinion, because you just need to have years in this industry.
Yeah,
and years investing in the market.
And I think people have heard the term compounding before, and usually it comes by compounding interest. But when you have a longer, hold time, or have the ability to have a longer hold time, you see things like rents compound, debt shrinks over time. When we talk about any of our properties where we're doing value add improvements, those will stabilize over time. So all of those things, that might have taken us back, 2 steps in the beginning because we're having to, expire bad leases, make some improvements and stuff like that, that really kind of catapults forward, in month 9 to 18. And then also cycles smooth out over longer holds. I want to go back to something you said earlier about leverage. So we talked about how real estate, there's leverage within real estate. Why is leverage so powerful when used responsibly, especially in the real estate industry?
Yeah, this is more of a, good debt versus bad debt. When you're applying debt onto cash flowing assets that really can't go to zero, they're producing cash flow, and the cash flow typically is going to be substantial after paying the debt service. Leverage is used by almost every real estate investor. There's some groups that do pay cash for things. Now, they may pay cash for it initially, then do a loan afterwards to close quickly, but for the most part, you need to have leverage to actually get a decent return. For example, if you were to pay cash for these properties today, you might get a 4 to 6% return in total in the investment, which is not very good. That's not great. However, you apply leverage to this, like I mentioned in my last example, is you apply a bank loan at let's say it's 70%. You've got 30% equity in the project. And let's say it's $1 million project, right? So 300 Rand your equity. If the property appreciates by 300 Rand, which is only 30%, you've now doubled your return because you had leverage on there.
Yep.
So leverage is a beautiful thing if done the right way. I don't believe in variable debt right now. I believe in mostly fixed rate debt. We're very risk averse when it comes to interest rate risk. And I don't believe in high leverage. I think that's where you can kind of get in trouble. So it's a good thing if you use the right way. Yeah,
like you said, like risk management is critical. Controlling large assets with less capital helps you kind of get a larger return, and then appreciation on the full asset is easier to achieve, or at least more simple to achieve when you're using leverage. So it sounds like everything that we've kind of talked about today is wealth in real estate isn't built overnight. So this is not a game for someone this is not a get rich quick scheme. There's really none out there that are reputable, and it's built through layering multiple return streams over time. Are there any kind of other layers or streams that are built within real estate, especially on the wealth side of things, that you think that people don't think of when they're just now getting into it?
I think you covered most of those. I say one more thing about the whole get rich quick piece is I thought back to my own journey in the real estate. And I invested in real estate for the first 3 years and didn't get really much at all cash flow. Like it was honestly almost zero. So it takes a lot of time. It just takes a lot of time to get that built up. But yeah, we covered the depreciation, we covered the cash flow, covered the leverage. Tax benefits are a big reason why people can build wealth there. But those are great, Jared.
Yeah. And in our next episode, we're actually going to do a deeper dive into what appreciation is and what appreciation really means, because I think that is part of the wealth building process that deserves its own episode. So
yeah, I agree.
Perfect.
Okay, let's go.
Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.